Hello, welcome to Inland Regional Center's training presentation. We are your trainers. My name is Jessica Artigame.
And my name is Stephanie Searles.
Inland Regional Center is a springboard to greater independence for people with developmental disabilities in the Inland Empire. Inland Regional Center was founded in 1972 and have provided support to people with intellectual disabilities, autism, cerebral palsy, and epilepsy. Today, we provide case management and service coordination for more than 45,900 clients in both Riverside and San Bernardino counties. Our core values is independence, empowerment, and inclusion. Our mission is as an agency among agency, IRC coordinates with generic services to enhance the lives of people with developmental disabilities and their families by working to include them in the everyday routine and life rhythms of the community.
So let's talk about what a nonprofit organization is, or more importantly, how to qualify and maintain a tax-exempt status. So the qualifications needed to become a tax-exempt organization include, for starters, the mission of the organization. In this case, by no chance should IRC be organized or operated for the benefit of private interest, and no part of a Section 501c3 organization's net earnings may inure to the benefit of any private shareholder or individual. Secondly, if the organization engages in an excess benefit transaction with a person having substantial influence over the organization, an excise tax may be imposed on the person and any organization managers agreeing to that transaction. Second, the second qualification are an organization's assets. In this case, IRC's assets must be permanently dedicated to an exempt purpose. That purpose is to provide services and support for people with developmental disabilities and their families. This means that if an organization dissolves, its assets must be distributed for the exempt purpose described in Section 501c3, or to the federal government or to a state or local government for a public purpose. The third qualification would be political activity and lobbying. IRC in this case is restricted in how much political and legislative lobbying activities they may conduct. This section will also be explained in detail in the latter section of the presentation. So, does the Inland Regional Center satisfy the commensurate test? Essentially, the commensurate test requires IRC to conduct charitable activities commensurate in scope with its resources. The idea here is that donors fund charities to do charitable works, not to amass a fortune with no clear plan of how the funds will be spent.
The Articles of Incorporation are important documents because they serve as a legal proof that your company is established in your state. The articles contain mandatory provisions which provide the state government with certain basic information about the corporation. As you can see here, Inland Regional Center second restated their Articles of Incorporation on March 15, 2006. As you can look at the third paragraph, it does say the specific and primary purpose of this corporation shall be to administer programs of services and resources for people with developmental disabilities and their families, including but not limited to assessments for eligibility, service coordination, counseling, case management, and public information, and to carry on other charitable activities associated with these goals as allowed by law. The company's bylaws defines the organization's operating rules. It is important to know that while the federal tax law does not require specific language in the bylaws of most organizations, state law does require nonprofit corporations to have bylaws, and nonprofit organizations generally find it advisable to have internal operating rules. Inland Regional Center can also specify its annual accounting period in its bylaws. It is through the bylaws that the organization can reinforce information on the activities that board members and directors should avoid when dealing directly or on behalf of the organization, which could jeopardize its tax-exempt status. The bylaws are also located on the Inland Regional Center website. Inland Regional Center must file an annual return by the 15th day of the fifth month after the company's accounting period ends. If your accounting period coincides with a calendar year, file your return or e-postcard by May 15th following the close of the tax year. From the filings, as you can see on the screenshot, Inland Regional Center had a gross total asset of over 133 million and a total gross receipt of over 550,000. If the organization doesn't file a complete return or doesn't furnish correct information, the IRS will send the organization a letter that includes a fixed time to fulfill these requirements. After that period expires, the person failing to comply will be charged a penalty of $10 a day. The maximum penalty on all persons for failures for any one return shall not exceed 5,500. And if by any reason Inland Regional Center fails to file its annual return as required for 3 consecutive years, its tax-exempt status is automatically revoked on and after the due date for filing its third annual return or notice. This may force the organization to lose its tax-exempt status and may need to file income tax returns and pay income tax, but may apply for reinstatement or exception.
As directors, it is very important that you understand how to avoid personal liabilities. Get to know the organization, get to know the rules and structure, learn about the legal form of the organization and its structure from its articles of incorporation as well as its bylaws. Understand IRC's activities, learn how we operate and the purpose of our programs. Learn IRC's rank order of priority, our number, and any possible overlap. Review all of the documentation, review documents that state IRC's purpose to determine compliance. It's also important that we understand the organization's other activities, committees, subsidiaries, directors' pet projects, members, personal interests or contacts, as well as community needs that may have introduced activities. Focus on budget expenditures that perhaps were not authorized in a normal way. And what's really important here is that we're asking questions. As directors, you should never be afraid to ask about any arrangement or information that is unclear to you. In this slide, we're going to talk about activities that could jeopardize an organization's tax-exempt status. So let's start with unrelated business income tax, or UBIT for short. And the good news here is that from the filing in Form 990, IRC did not have any unrelated business income tax. But, just so that we understand a bit more about what that looks like, UBIT is when an organization derives net income from one or more unrelated business activities and is subject to tax on that income. An organization's tax exemption will be denied or revoked if an inappropriate portion of its activities is not promoting one or more of its exempt purposes. An example of this could be, for IRC, let's say that we decide to sell something, right? And we include a hyperlink from or on our website to a sponsor's website. And let's say it's for maybe a pharmaceutical company where an endorsement appears by IRC for the sponsor's product. In this case, or in this example, the activity is not directly related to our mission in which the organization in which we qualify for tax exemption. In such a case, if we were to make $1,000 or more of gross income from an unrelated business, we then would have to file Form 990T. Another activity that perhaps would jeopardize our tax-exempt status could be prohibited political activities or lobbying. So, according to the IRS website, no organization may qualify for tax-exempt status if a substantial part of its activities is attempting to influence legislation. Therefore, IRC may engage in some lobbying, but too much lobbying activity risks loss of our tax-exempt status. An example of a lobbying event that could become an issue would be, lobbying for a legal stance, and in the process, comparing it with the stance that a political candidate is taking during an electioneering cycle, or in one way or another affects the confirmation of an appointive office of an individual. In this example, the exempt organization, us, could be viewed as participating in a legislative process and in favor of or even against the appointed individual, and by extension, participating in politics. Another activity could include gambling or gaming. And I know this is a lot of information, but this is really important stuff. So hang in there. We're almost there. So just to get back to gaming, a gaming activity is always required to be reported on Part 8 of our Form 990, regardless of the amount. Essentially, any game of chance, like even like bingo, is considered a gaming activity. So as a general rule, gaming activities are considered an unrelated business income activity and are therefore taxable. However, a gaming activity conducted entirely by volunteers may be exempt from unrelated business taxation. The organization may have an issue if, let's say, on our annual golf tournament that we conduct a raffle as a build-up event. And in that process, a significant time is spent by employees of the organization, putting this together. Let's say that they worked on this for the 11 months leading up to the event. In that case, the IRS will view this as a regularly conducted activity, making the event qualify as UBIT in the tax schedule. It's also important to note that for certain games, some specific excise taxes and filing requirements may apply. And unless your game meets one of the exceptions to being treated as an unrelated business activity, the income may be unrelated business income, which is taxable to the organization just like regular income.
We would like to say thank you for watching our presentation and thank you for being part of Inland Regional Center.